Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, I'm going to be responding to your comments that you left in response to a video on dividends. I called it the free dividend fallacy. And basically, the point of the video was to try to put dividends in perspective and say, look, the payment of a dividend in and of itself doesn't increase your wealth. And that got a lot of comments. So we're going to cover some, I'll call them dividend investing myths in this video. We're going to look at 7 of them. And they all come from you. So these are comments that you left. And some of the comments, I'm going to just say, were not particularly friendly, but that's okay. That's what we're going to do today. Now, we actually got 3 things. The first thing is, some of you didn't like the example I used of a bank and a savings account and interest. So we're going to briefly look at the sale of a business. Then we're going to cover the seven dividend investing myths. And then I'm going to finish with answering the question, so what? How does this really matter? How can this help us become better investors? That's the goal. Now, let's start with a slightly different hypothetical. I used a bank savings account last time, and several of you didn't like that. So I'm going to try again. Let's imagine you are going to buy a business. It's a $10 million business. We'll say it invests in real estate. It owns single-family homes and rents them to tenants, and that's the business. And it's got, we'll say $9.5 million in real estate and $500,000 in cash for working capital. And that's the business. You're going to buy it for $10 million. You and your lawyer show up the morning of closing, and you're looking over the paperwork before you sign, and your lawyer sort of nudges you. And I've been there before as the lawyer, not so much as the buyer, but the lawyer nudges you and says, look, I'm looking at the financial, we got a problem. You're like, what's the problem? Well, isn't there supposed to be $500,000, in the bank? Yeah, there's only 250,000. So you pause for a moment, you look across the table, there's the seller, they're smiling, they're happy, they're going to get 10 million. Their lawyer, and you say, we got a problem. We're supposed to have $500,000 in the bank, and I only see 250. What's going on? Oh, don't worry. Last night, I paid myself a dividend. We know dividends don't affect the value of a company. It was just a dividend, no big deal. And by the way, the company can still operate with the $250,000 it has in cash. So nothing to see here. It was just a dividend. Well, I don't know about you, but if I'm buying, I ain't paying 10 million bucks. I'm paying 9.75 million. I'm reducing the purchase price dollar for dollar for the dividend that the owner took out the night before. It has real world consequences. And when it comes to investing, I think it's critical that we think about any investment we make or the sale of an investment that we own as buying or selling the entire company. When I analyze Apple, for example, I imagine buying the whole thing. And that either makes sense or it doesn't. And if it doesn't, I'm not going to buy a single share. And if it does, then yeah, I'll buy what I can. But it's really important to see the investment in stocks just like you're buying a whole business. And sometimes that's difficult because you got the market, you got all the news, the price is fluctuating all the time. With a private business, that doesn't happen. It's not like if you owned a dry cleaner, every 3 seconds someone walked in the door and shouted out a price they were willing to pay for your business. That's exactly what happens effectively in the stock market when the market is open. In the real world, it doesn't happen that way, but I believe we should still think about and evaluate our investments in stocks just as if we were buying an entire business. All right, I don't know that you guys are going to like that analogy any better than the bank one from the past video, but there you go. All right, let's dive into the 7 myths. The first one is personal. There's this, I think, notion out there that I hate dividends, and nothing could be further from the truth. It's just that I put dividends in what I believe to be the right perspective. What I really like are great companies at good prices. When I'm investing in individual stocks, and most of our portfolio is in index funds, but we have now, it's growing, I would say roughly 20% of our portfolio is in individual stocks. I'm looking for great companies at a good price, and it turns out that most great companies at a good price pay a dividend. Now, they don't all. Berkshire Hathaway, I think, is a great company at a good price-ish, and it doesn't pay a dividend. But I think the vast majority of great companies at good, fair, reasonable prices pay a dividend. And I also like the fact that with a dividend, management has to think about shareholders. Now, I don't think that the fact that a company pays a dividend means that they think about shareholders in the way that they should. And just because a company doesn't pay a dividend doesn't mean they're ignoring shareholders. I think Warren Buffett is very much his job, he sees it, is to protect the shareholders, among others, and they don't pay a dividend. But by and large, I like the fact that companies with dividends, have to think about their shareholders at least once a quarter when they're paying that dividend. And that gives me some comfort. So I actually like dividends, but I see them more as sort of they're the tail. They're not wagging the dog, hopefully. They're the tail. They're what comes from a well-run company, and hopefully one that I've purchased at a fair price. So I don't hate dividends. I just try to put them in the right perspective. Okay, that's myth number one that I read in some of the comments. Now I'm going to actually start reading some of your comments, and that brings us to number two. And this is the idea that dividends are great for the compounding effect that you get from reinvesting the dividends. And I'll give you a couple of examples here. A viewer named Jeff said, no company goes into your brokerage account, takes money out, and then sends it to you as a dividend. I think he was responding to my bank example. Yes, the stock price drops by the price of the dividend. This is one of many factors affecting the stock price, which can change minute by minute throughout the trading day. Looking at old line companies, names like Johnson & Johnson, Coca-Cola, etc., and consider where you'd be if you had bought these stocks, say 50 years ago, especially if you'd been reinvesting those dividends. You would have received all those dividends and the value of your investment would be way higher than when you bought it. Well, first of all, there's absolutely no question that when you're accumulating assets, that is before you get to retirement, it is absolutely critical to reinvest your dividends. You're not going to get any argument from me. It's exactly what we did. And even now, as I move into semi-retirement, we're still reinvesting some of our dividends because we don't spend them all. And so dividend reinvestment is critical to grow your wealth. And that may seem at odds with my view of dividends, but here's the thing. You don't need dividends for compounding, right? Think about Berkshire Hathaway. Has it compounded over the last 50 years? You bet it has, and it hasn't paid a dividend, not a cent since I think the 1950s, if I've got the dates correct. And they haven't paid a dividend. Has Google, I guess Alphabet, has it compounded since it went public? You bet it has, and it doesn't pay a dividend. Look at Amazon. How does that happen then? I mean, normally we think about compounding, we think kind of about getting something, interest or dividends, and then putting it back into the investment. But if you think about a business, the way a business like Berkshire, for example, compounds is through earning profits and then reinvesting those profits back into the business. And so a company like Berkshire reinvests its profits back into its business by acquiring new businesses. He invests in some public companies. They might use the money to make their operations more efficient. He talks about bolt-on acquisitions where there are smaller acquisitions that help existing companies owned by Berkshire. So they have a lot of ways of taking the profit and reinvesting it back into the business. So you don't actually need a company to pay you a dividend so you can then go buy more of its shares in order to get compounding. Certainly, if a dividend is paid and you want to maximize your wealth, you want to reinvest that dividend. But that money that's going back in isn't magical because it came from a dividend. I mean, any source of money that you can generate to invest is going to grow your wealth. Certainly, if it comes from dividends, fine, reinvest them. Maybe it comes from working and spending less than you make. As longtime viewers know, we invest our credit card rewards. So when Citibank or Chase or Capital One gives me cashback rewards from our credit cards, we invest that right into our investment. So the source of the investment really isn't all that important, and it certainly doesn't change the numbers. A dollar invested is a dollar invested. It doesn't matter if it comes from a dividend that was paid to you, interest that was paid to you, your job, or credit card rewards. A dollar is a dollar. But yes, certainly true. We want to reinvest our dividends. I just think it's important that we keep it in the right perspective. All right. The third myth, this is really important, and it's this idea that dividends are the best way to get value out of your investment. You've invested in a company. The best way to get that value out, or some portion of it, is from dividends. One commenter, the same one I mentioned, Doug, he says, I love the folks that are right to the point. Here's how he starts out his comment. You're totally wrong. I like that. Don't beat around the bush. Don't thank me for my effort. That's all nonsense. Just get right to it. And I like the adverb. Really good. You're totally wrong. Not just partially or just wrong. Anyway, he goes on, he says, if instead of a stock, you bought a variety store, you would probably expect to be paid a portion of the store's earnings. Not that the store's earnings would be kept in the safe at the back. That's presumably why you bought all or part of a business. Okay. And then another viewer said, I think his name is Grav, and I'm sorry if I've completely mispronounced that. He says, in your example of selling at the bottom versus receiving dividends, you missed the point that receiving dividends doesn't reduce your ownership in a company, but selling stocks will. And I think this is maybe the most important myth we're going to talk about today, this idea that there's value in not selling shares. If you can just get the dividend and you still own 100 shares or 1,000 shares, even if the price has gone down, that's somehow better. Now, question, would you rather own 100% of a $9 million company or 90% of a $10 million company? Well, at the end of the day, both investments are worth the same to you. It doesn't matter. And here, I think I'm going to have to bring out the big guns, and that is Warren Buffett, because he talks about this very issue. And let me show you. This is the letter to Berkshire Hathaway shareholders, the 2012 letter. So it would have been released in 2013. You can just Google 2012 Berkshire Hathaway letter, you'll find it. And in it, he has a discussion about why Berkshire Hathaway doesn't pay a dividend. And let's start. I'm not going to read this whole thing. I highly recommend that you read it. I think it's incredibly educational. And Warren Buffett can describe complicated finance issues in ways that are really easy to grasp. But I do want to read a couple of things. He starts off with this first paragraph. He says, a number of Berkshire shareholders, including some of my good friends, would like Berkshire to pay a cash dividend. It puzzles them that we relish the dividends we receive from most of the stocks that Berkshire owns, but pay out nothing ourselves. So let's examine when dividends do and don't make sense for shareholders. Now, he walks through an answer to that question. I can tell you at a high level, he says from a corporate perspective and from an investor perspective, what we want companies to do is first take their profits and if they can, reinvest that money profitably back into the company. They could, again, make their operations more efficient and reduce expenses. They could expand in new territories. They could invest in research and development to come up with new products. They could make sensible acquisitions. And once they've done that, if they have money left over, another thing to do is to repurchase their own shares if they can do it at sensible prices. And yes, eventually, potentially, a dividend would make sense. But then he went through and he compared to investors and getting money out through a dividend and getting money out through just sale of shares. And this is really the point I want you to focus on. I'll leave it to you to go to this letter and read all the details if you want, but the takeaway is what I want to show you. And this is where Warren Buffett uses a very specific example, and it is right here. He said, I'm starting right here in the letter, so this is page 20, I think, 21. He says, let me end this math exercise, and I can hear you cheering as I put away the dentist drill, by using my own case to illustrate how a shareholder's regular disposal of shares can be accompanied by an increased investment in his or her business. For the last 7 years, I have annually given away about 4.25% of my Berkshire shares. Through this process, my original position of about 712 million B share equivalents. Can you imagine owning 712 million shares of Berkshire, even the B shares? Anyway. Split adjusted has decreased to 528 million shares. So he's gone from 712 million all the way down to 528 million. Clearly, my ownership percentage of the company has significantly decreased. Yet my investment in the business has actually increased. The book value of my current interest in Berkshire considerably exceeds the book value attributable to my holdings of 7 years ago. The actual figures are 28 billion for '05 and 40 billion for 2012. In other words, I now have far more money working for me at Berkshire, even though my ownership of the company has materially decreased. It's also true that my share of both Berkshire's intrinsic business value and the company's normal earning power is far greater than it was in 2005. Over time, I expect this accretion of value to continue, albeit in decidedly irregular fashion, even as I now annually give away more than 4.5% of my shares. I think the big takeaway is it's not just the number of shares we own, and we shouldn't fall in love with this idea of never selling a share and relying just on the dividend. So I hope that gets through to everybody, and I highly recommend you reading all of that portion of Warren Buffett's letter to Berkshire Hathaway shareholders. It's very helpful, and frankly was part of the process I went through to put dividends in the right perspective. All right, myth number 4: stock dividends are better than interest from a bond. And here, a comment from a viewer named Doug. He says, as far as having any portion of your investment in bonds, so you have something to rebalance with in the last part of your argument, you really should be concerned about running out of money in retirement. And then he went through a comparison of a particular bank that had to cut its dividend, but then ended up doing well in the long term. So here's the thing: comparing stock dividends and bond interest is truly like comparing apples and oranges. They're totally different. There is absolutely no question that one of the big risks of a bond and the interest it pays is inflation. You can think about it this way. Imagine you lock into a 2% bond for 10 years and inflation hits 4%. Well, you're losing money on an after inflation basis for the rest of the term of that bond. Or if you're selling the bond, you're selling it and taking a big haircut and losing a lot of money. In the case of a stock dividend, if the company is doing well and it's able to continue to earn more and more, it might be able to actually increase its dividend potentially to keep pace with inflation, or maybe even to exceed inflation. So there's absolutely no question that the risks associated with interest from a bond are totally different than the risks associated with a dividend from a stock. However, we shouldn't assume that just automatically makes dividends better than interest all the time, and that it justifies a 100% stock portfolio. Consider this. In the 2008-2009 financial crisis, dividends were cut in the S&P 500, and we're talking about the actual dividend itself was cut across all the companies that pay dividends by 23%. Dividends cratered. And it's not the first time that's happened. And I've read that it took, in nominal terms, in other words, before even factoring in inflation, it took until 2012 to get back to where we were before the crash. So yes, at one level, dividends are, I think, more stable than the price of a stock. We shouldn't compare them to bond interest. They can be far more volatile than interest in bonds. Again, it doesn't make bonds and interest better than dividends and stocks, or the other way around. They're two different things. They have different risks associated with them. There's no question in my mind that for long-term investors, stocks are better than bonds, and that's why I personally own more in stock and stock funds than I do bond and bond funds. But we need to recognize that dividends can and do get cut in difficult times, and if you're trying to rely on them to fund your retirement, think about how you do with a 23% cut in 2008. 2009, and one that didn't recover even just on nominal terms for 3 or 4 years. That would be a pretty significant event to live through. So yes, I absolutely agree that dividends are different than bond interests. They both have advantages and disadvantages for long-term investors. As I think we all know, stocks make more sense than bonds, But I also don't believe that that means that you shouldn't have bonds, even in today's environment, and that a 100% stock portfolio is ideal. I think for most people, it's probably not. All right, number 5. This is an important one. A commenter noted that qualified dividends are tax-free up to a certain point if you're married filing a joint return up to $80,000. Tax-free. Now, the first question is that right? Well, turns out, yeah, it is. Let me show you. This is the capital gains rate. Let me see if I can make this a little bigger. Maybe. Here we go. So this is married filing jointly, long-term capital gains rate, 0% on the first 80,000. Again, if you're single, the number is 40,000. If you're married, the number is 80,000. And actually, the number is really kind of higher because you'd have your standard deduction to offset the income. Now, I'm not going to get into how ordinary income affects capital gains tax rates. Maybe I'll do that in another video. But it's absolutely true that qualified dividends are tax-free up to this point at the federal level, assuming you have no other income, right? But here's the thing. The reason qualified dividends get this treatment is because they're taxed as long-term capital gains, right? At least in most cases. So what does that mean? Well, if I sell shares that I've held, for more than 12 months, it's the same thing. It's the same tax rate. So this actually isn't something that is specific to qualified dividends. It actually applies to long-term capital gains generally. Again, the interplay between the capital gains tax rate and the ordinary income tax rate is really important to understand. I'll cover that in a future video. All right, number 6, stocks often go up in price after a dividend is paid. This is a very interesting point that you guys made. And I'm going to read 2 comments. One, again, was from Gaurav, who I'm sure I'm completely obliterating that name, but here's what he said. There is a bit of misunderstanding from you between price and value of a stock. Great dividend-paying companies will only pay out cash that is irrelevant to long-term trajectory of their business. All right. It's true the stock price goes down when a dividend is paid, but 2 things remain the same. Your ownership in the company and the worth of the company's business. That's the reason stock price recovers like nothing happened. A good way to make sure you are owning high-quality businesses like these is owning indexes, and he mentioned a couple of ETFs. A viewer named Steve made effectively the same point. I agree this video is misleading. When the ex-dividend date approaches, the dividend is priced into the stock. Right after the ex-dividend date, the value decreases. However, over time, the stock price of a quality dividend stock should increase. Take a look at a stock like Pepsi, paying dividends for decades, and today the stock is 5 times the price of what it was in the 90s. If I take this video at face value, the stock would eventually be worth 0. Okay, well, I don't understand that last comment. But it's an interesting point. We could, I guess, look at the data and we could evaluate what happens to the stock when it trades after it's been reduced by the amount of the dividend. Does it just go up every day? Now, here's the problem, though. What happens on any given day is by and large irrelevant. What we care about is long-term performance. And yes, you're absolutely right that most companies that do well, even that pay a dividend, the value of their stock goes up over time. We can fall off the cliff in a 2008, 2009 financial crisis. We can have bear markets, but by and large they go up. And I think you're right that most companies don't pay such a large dividend that it's going to hurt the operation of the business, right? That would be obviously a huge mistake. Sometimes companies do that, and you can look at their payout ratio, for example. You can also evaluate whether they're borrowing to pay their dividend, and that can only go on for so long. So there are some extreme examples, and in fact, Enron paid a dividend of over $300 million, as I recall, just a couple of months before it went bankrupt. So yeah, there are always examples of craziness in the financial markets, but by and large, I agree with both of those comments that over time, good companies go up over time. But I'm not sure that means that the payment of the dividend has no effect on the value. I mean, you think about it this way, and this is where I think it's important to look long term. Apple started paying a dividend in about 2012, I think. I'm sure you'll correct me if I'm wrong. Over the last, about a decade, I think they've paid roughly $100 billion in dividends, roughly. Now, if we could just snap our fingers and all of that cash was back on their balance sheet, would the company be worth more? Well, I would submit to you that it would be worth more by an amount roughly equal to $100 billion. Now, what the market would do day one after that happened, I don't know. The market does all kinds of crazy things for all kinds of crazy reasons. It's one of the reasons Warren Buffett has said, in the short term, the market is a voting machine, but in the long term, it's a weighing machine. Eventually, that capital is going to get weighed into the value of a business. And the fact that dividends reduce the value of a company, and I think, to me, it absolutely does. You're pulling cash out of the company. It's as simple as that. Doesn't make dividends bad. Doesn't mean we should avoid dividends, but it also means we shouldn't fall in love with them. And that kind of gets to the so what question I'm going to address. But before I do, one more important myth. This is number 7. Growth stocks are better than dividend paying stocks. This came from and I'm paraphrasing, but this came from a viewer named Wade. He said, I've always wondered about this. If I'm investing for the long term, why is investing in high dividend yield ETFs preferable when a growth ETF, which may pay very little dividends, has an overall better return? Well, it's an interesting question. Here's the thing. Growth investments have their day, and so do value investments. And over the last decade or so, growth investments have, by and large, outperformed value. That's certainly true with large cap stocks, large cap companies in the United States, but that's not always true. And there can be periods of time where value outperforms growth. And that certainly happened in the past. And that's true, frankly, regardless of what the dividend yield is for either value stocks, which tend to have higher dividend yields, or growth stocks, which tend to have lower dividend yields. I do think one of the things that's helped growth stocks over the last decade is historically low interest rates. But this seventh myth actually gets me now to the so what question. The real point of all of this is that we shouldn't fall in love with dividends. If we want to fall in love with something related to at least the finance market, absolutely fall in love with great companies at good prices, which often, I think, pay a dividend. For index fund investors, I think the focus should always be on total return. Whatever the dividend yield is, that's great. It'll come. If you're accumulating your money, you'll reinvest the dividends. If you're in retirement, you might end up spending the dividends. That's frankly primarily just for convenience and maybe tax reasons if it's in a taxable account. But at the end of the day, my view is no matter if you're 20 and you got 40 or 50 years to retire, or you're 65 and you're in retirement, our focus should be on total return. It shouldn't be to tilt the portfolio to a higher paying dividend. If we're investing in individual stocks, we should look for great companies at good prices, whether they pay a dividend or not. Again, I think most of those types of companies do pay a dividend, but they don't all. And our goal should be great companies at a good price, and our focus should always be on total return. Now, one of the questions where this gets really interesting is once you enter retirement, and I've alluded to that. So I'm working on a video, and in fact, I think it'll be the next video I publish on how should we think about dividends as we get ready for retirement and enter retirement. Are dividends more important once we retire? Should we tilt our portfolio towards more dividend-paying stocks or dividend-paying ETFs or mutual funds? That's the question I'm going to tackle in the next video. As always, love to hear your comments. I mean, feel free to tell me I'm wrong. I'd be grateful if you were kind, but I suppose you don't have to be. For those of you that have made it to the end of this video, I do have a public service announcement. I've noticed that some scammers leave comments pretending to be me. It even has my picture, it has my name, although the typeface is a little weird. And the most common type of comment wants you to text them, and it leaves a phone number. Yeah, that ain't me. That's a scammer or spammer. I don't know who it is. I delete them when I see them, but there's simply no way I can delete them all. So trust me, I'm not giving out my phone number and asking you to text me. That's not me. So bear that in mind when you read the comments. Listen, hope you have a great day. And until next time, remember, the best thing money can buy is financial freedom.